I am Reed, I am 27, just an average dude. I've made tons of money mistakes in my 20s, and now I want to share everything I've learned to help you take control of your finances and your life. So let me start with something real. For the longest time, I thought dividend investing was boring, like genuinely boring. I was in my early 20s thinking I needed to hit home runs with every trade. I wanted the 10x, I wanted the meme stock that would triple overnight. I wanted to be that guy who threw 500 bucks into something random and woke up with 5 grand. Sound familiar? Yeah, I thought dividends were for people in their 60s sitting on a porch drinking coffee with $2 million in the bank. I thought dividends were slow and pointless, and I was way too young for that nonsense. And honestly, I was dead wrong. Let me tell you about my journey with this whole thing, because I think a lot of you are probably where I was a few years ago. Back when I was 22, 23, I was a mess with money. I was living paycheck to paycheck. I had credit card debt. I was buying stuff I did not need just to feel like I had my life together. I remember one time I spent $800 on a camera I barely used because I thought it would make me look like a content creator. Spoiler alert, it did not. I was chasing the wrong things, and my investing strategy back then was the same. I was chasing the shiny object. Whatever was trending on Reddit or TikTok that week, I was throwing money at it, and I lost a lot. Not like life-ruining amounts, but enough to make me sit down and actually ask myself, what am I doing? So I started learning. I read books, I watched hours of YouTube, I followed people who actually knew what they were talking about, and one thing kept coming up over and over again: dividends. But not just dividends, dividend growth. And at first I was like, okay, cool, boring stuff, but then I actually looked at the numbers, and that is when it clicked for me. Let me break down why dividend growth investing changed the way I think about money, and I promise I will keep it simple, because frankly, I am not a finance guru. I am just a guy who made bad choices and figured some stuff out along the way. The first thing that got me was the retirement fear. Think about this. You spend 30 years saving and investing. You have a solid chunk in the S&P 500, maybe $1 million. You are ready to retire. You are picturing yourself relaxing, spending time, with family, traveling a little, and then boom, market crash. That million you had is now 700,000. Still a lot of money, sure, but now you are panicking. You are thinking, maybe I should work a few more years just to be safe. Maybe I cannot afford to retire yet. That fear is real. I have talked to people who lived through 2008, and they told me they knew people who had to delay retirement by 5 years because of that crash. 5 years, that is time you cannot get back. Now here is where dividends come in. With dividend growth investing, you do not have that same problem. Obviously, your portfolio value will drop during a crash. That is just how the market works. But here's the thing. The companies that pay and grow their dividends consistently do not just stop paying because the market is down for a few months. These are businesses with real cash flow. They have been through recessions and crashes and wars and pandemics. They know how to keep the lights on. So during a crash, your dividend income stays basically the same. And if those companies keep raising their dividends year after year, your income actually goes up even when the market is down. That was the moment my brain started to shift. Let me give you a real example. There is a guy I follow called Dividendology. He has about $200,000 in his portfolio. It pays him roughly 6 grand a year in dividends. During the last major market downturn, his portfolio lost about $25,000 to $30,000 in value. That sucks, no doubt about it. But guess what? He was still making the exact same amount in dividends. The companies he owned did not cut their payouts just because the market was being dramatic. They kept paying because they could afford to. And that is the whole point. When you own quality companies with low payout ratios and consistent cash flow, your income stream is way more stable than your portfolio balance. Let me talk about another example that stuck with me. I was looking at Constellation Energy recently. They made around $1 billion in a single quarter, just one quarter, and their entire yearly dividend cost them about $400 million. So in one quarter, they made enough to cover their whole year of dividends more than twice over. That is the kind of safety you want to see. That is not a company that is going to panic and cut your dividend because the economy sneezes. And then you have companies like Low S. This is insane. Low S has been paying and raising their dividend for 61 years straight. 61 years. Think about everything that has happened in that time. The oil crisis in 73, 74, Black Monday in 87, the dot-com bubble burst, the 2008 housing crash, COVID, the inflation mess, the tariff stuff. Through all of that, Low S kept paying and raising their dividend. That is not luck. That is a business model built to last. And there are dozens of companies like that. Coca-Cola, Procter & Gamble, Johnson & Johnson. These are not speculative bets. These are businesses that have been printing money for decades. Now, I want to talk about something that confused me for a long time. The difference between high yield and dividend growth. When I first started looking into dividends, I thought I wanted the highest yield possible. I saw a stock paying 8% and I thought, wow, that is amazing. But here's the problem. A lot of those high yield stocks have no dividend growth. The yield might be high today, but in 10 years, you are still getting the same dollar amount per share. Meanwhile, inflation is eating away at your purchasing power. So really, you are making less every year in real terms. And the stock price barely moves. The equity curve is basically flat. You are stuck. Dividend growth is completely different. You might start with a lower yield, maybe 2 or 3%, but if that company raises its dividend by 8 to 10% every year, something incredible happens. After 10 years, your yield on cost could be 6 or 7%. After 20 years, it could be 15% or more. You are outpacing inflation, you are growing your income. And the stock price usually goes up over time too because the company is growing its earnings. So you get both income growth and price appreciation. That is the magic of it. The equity curve might start slow, but eventually it shoots up like a hockey stick. The dividend growth pyramid is something I came across that made everything click into place. There is a great video from the Dividend Growth Investing channel on YouTube that breaks it down. The pyramid has different tiers. At the bottom, you have companies with the highest yield but the least growth. These are your utility stocks and REIT stuff that pays well but does not raise much. As you go up the pyramid, the yield gets lower, but the dividend growth rate gets much higher. At the top, you have companies like Visa, Costco, and Loas that have incredible dividend growth history. The idea is that you pick your spot on the pyramid based on your time horizon. If you are retiring in 1 to 3 years, you want the bottom of the pyramid for maximum current income. If you have 10 to 20 years, you want companies with 9 to 12% dividend growth. If you have 20 plus years, you want the top companies with 12% plus growth. That framework made so much sense to me because it matches your strategy to your timeline instead of just picking random stocks. Now let me talk about DRIP because this is the part that honestly blew my mind. DRIP stands for Dividend Reinvestment Plan. It just means you automatically reinvest your dividends to buy more shares instead of taking the cash. And I know that sounds simple, but the effect over time is insane. Let me walk you through an example that Dividendology shared. He used a calculator to project forward 10, 20, and 30 years. He started with a $10,000 investment. He assumed a 7% price growth rate, an 8.5% dividend growth rate, and a 3.5% starting yield. And get this, he assumed 0 monthly contributions. Just the initial 10 grand and nothing else. With DRIP after 10 years, you would be making about $100 every single month completely passively. After 20 years, you are making over $300 a month. At year 23, you hit $500 a month, and your account value is around $120,000. Then just 5 years later, at year 28, you are making $1,000 a month. Let me say that again. You put in $10,000 once, did nothing else for 28 years, and you are making 12 grand a year in passive income. That is more than you put in every single year. And if you set up DRIP automatically, you literally do not have to think about it after day one. That is the closest thing to set it and forget it that I have ever seen. Here is the comparison that really got me. If you did not use DRIP, it would take you 30 years to make just $300 a month. 30 years for $300 a month versus 28 years for $1,000 a month. The DRIP strategy is not even close, and the reason is the snowball effect. Once your dividends start buying more shares, those new shares generate their own dividends, which buy more shares, which generate more dividends. It compounds, and the longer you let it run, the faster it grows. That is why it took 23 years to hit $500 a month, but only 5 more years to double that to $1,000. The snowball gets bigger and moves faster the longer it rolls. Now, I know what some of you are thinking, 28 years is a long time. I get it. I am 27. 28 years from now, I will be 55. That is not exactly tomorrow, but here's the thing. The time is going to pass anyway. Whether you invest or not, you are going to be 28 years older. Would you rather be 55 with a passive income stream or 55 still wondering how to start? And there is a way to speed this up way more. If you add monthly contributions, the numbers get crazy. In the same example, if you contribute just $250 a month, it only takes 14 years to hit $500 a month. 14 years instead of 23. That is almost half the time. So if you are in your 20s like me and you can put away a couple $100 a month, you could be looking at serious passive income by the time you are in your early 40s. That changes everything. I want to be real with you guys about my own situation. I am not some big shot investor. I do not have a massive portfolio. I am still early in my journey. I have been focusing on building my emergency fund, paying off debt, and then slowly building my investment account right now. I am putting money into a mix of ETFs like SHD, which is a dividend growth ETF, and VOU, which tracks the S&P 500. I am not trying to get rich overnight. I am trying to build something that will be there for me in 10, 20, 30 years. And honestly, that mindset shift was the hardest part for me. I used to want everything right now. I wanted the instant gratification. I wanted to see my portfolio go up 10% in a week. But that mentality kept me broke and stressed out. Once I accepted that slow and steady is the real game, everything got easier. Let me share a personal story. A few years ago, I had about $3,000 saved up that I was planning to put into the market. Instead of just buying a solid ETF, I decided I was going to be smart. I researched a hot stock that everyone on Reddit was talking about. It was some biotech company that was supposedly about to release a breakthrough drug. I put the whole $3 grand in. 2 weeks later, the drug trial failed and the stock dropped 60%. I panicked and sold at a loss. I walked away with about $1,200. That was $1,800 gone. If I had just put that $3 grand into SHD or VO, I would have probably made a few $100s instead of losing most of it. And that is the thing about dividend growth investing. It is not exciting. It is not going to make you a millionaire overnight, but it is not going to wipe you out either. And for someone like me who has made plenty of stupid mistakes, that boring consistency is exactly what I need. Another thing I love about dividend growth investing that I do not hear people talk about enough is that you never have to sell anything. With traditional investing, you eventually have to sell your shares to generate income in retirement. That means you are slowly liquidating your nest egg. And if you live longer than expected, or if the market crashes early in your retirement, you could run out of money. With dividends, you keep your shares, you keep the wealth, you pass it down to your family. Your kids or grandkids can continue collecting that dividend income for decades. That is generational wealth building, and it does not require you to be a millionaire. Even a modest portfolio of dividend growth stocks can provide income that lasts forever. I remember talking to my dad about this last year. He has always been a saver but never really invested. He has money sitting in a savings account earning basically nothing. I tried to explain dividend growth to him and he was skeptical at first. He said it sounded too good to be true. So I showed him the numbers. I showed him companies that have raised dividends for 20, 30, 40 years straight. I showed him how a $10,000 investment in Coca-Cola 30 years ago would be paying you thousands a year now. He started to get it. He is still nervous about the stock market, but at least now he is open to learning. And that is all I can ask for. Small steps if you are watching this and you are in your 20s. Let me give you some honest advice. Start now, even if it is just 20 bucks a week. Even if it is just 50 bucks a month. The most powerful thing you have right now is time. I know it does not feel like it. I know life feels slow and you want things to happen faster, but time is literally the one thing you cannot buy more of. And the earlier you start, the more the snowball works in your favor. Every year you wait is a year of compound growth you will never get back. I wish someone had told me this when I was 19. I would have started then. But the next best time is today. And look, you do not have to be a dividend investor. You can put your money in the S&P 500 and do just fine. That is a perfectly valid strategy. But if you want a stream of passive income that grows over time and protects you from market crashes and inflation, dividend growth investing is worth looking into. It changed my perspective on money entirely. It made me think long-term instead of short-term. It made me stop gambling and start building. I want to end with this. I am not a financial advisor. I am just a normal 27-year-old guy who made a bunch of dumb mistakes and is trying to do better. Everything I share is based on my own experience and research. You should do your own research and make your own decisions. But if any of this resonated with you, if you are tired of chasing quick wins and losing, if you want to build something real that actually lasts, then maybe give dividend growth a shot, read about it, watch some videos. Look at the numbers, you might be surprised at what you find. I also want to give a quick shout out to Dividendology and the Dividend Growth Investing YouTube channel. Their content taught me a lot of what I know. I will link their videos in the description if you want to dive deeper. And honestly, even if you just watch this video while eating lunch or whatever, I appreciate you being here. If you got something out of this, hit that like button and leave a comment. I actually read comments and I love talking to you guys. Let me know what your dividend journey looks like or if you are just getting started. Either way, I am rooting for you. Peace.